People often believe that there's really only two camps or two choices to investing. The first camp or choice is that long only big box choice, where your money's always in the market, it never gets taken out. People who kind of wake up and go, oh my gosh, that may not be what's best for me, they move over to this second camp, which let's call it the do-it-yourself, which the majority where people live in the do-it-yourself world is they live in the pick of the month newsletter world. So most people believe there are only these two camps to grow your money. But actually that's wrong. And if they just notice that those two camps are on one side of the river, and in fact there is a river, and on the other side of the camp is that stability and that steadiness and that consistency, then they'd start to say, okay, well then how do I get to the other side of the river? Like where's the bridge? How do I get to that side? And this is what this conversation is about. Everybody, this is RC Peck, and this is my weekly thought. And I want to talk about that bridge. Though it's a metaphor, there's 5 steps. And if you take the 5 steps, and what I love is there's only 5 steps, that gets you to the other side. That gets you to the steadiness. It gets you to the stability. It gets you to the place where you have more choices. So let's talk about those 5 steps. So step number 1 is just literally recognizing that there are 4 and only 4 asset classes on the planet to put your money. And here's the key part to this first step. Your money is always invested at all times. There's no setting your money aside. There's no having $50,000 in cash or $500,000 or $5 million in cash and thinking that's set aside. That's a fixed income. Currency and bonds are fixed income. Stocks are stocks. Commodities are commodities, and real estate is real estate. So when you realize that your money is always invested at all times and realize there's no such thing as setting money aside, you start the process of safely accelerating your money. So step number 2 is saying, okay, of those 4 asset classes, which is the best? Now here's the thing, not one of them is best all the time, and we'll get to that. But step number 2 says, okay, of the 4, which is the best? And the answer is the equities asset is the best, 78% of the time. So step number 2 is identifying what the best asset is, which is stocks, buying an index, in this case, the S&P 500. And here's the key to step 2. Not only that, but literally clicking a button on your brokerage site saying reinvest my dividends. When you do that, literally that causes tens of thousands or hundreds of thousands or millions of more dollars to end up in your account over the lifetime of the growth of that money, which is gigantic. Okay, so step 3. I do not believe in the long only approach. So step 3 is literally a question saying, should I be in or out of the market? And in this case, the market is the stock market because 78% of the time, the market's going higher. The stock market is beating the other 3 asset classes. So step number 3 literally is saying, okay, should I be in or out? And I just told you now for the third time, most of the time you want to be in the market. But literally just asking that one question, should I be in? It's going to help you avoid the 22% of the time when the market, though, and I want to say this, though the 22% of the time is short on the time scale, it's really long on the potential devastation to your stability and your steadiness and your choices scale. So step 3 is asking that first question, should I be in or out of the market? And when you do, it literally greatly changes how stable and how well your money grows over any 7-year period. Okay, but now we have step 4. And again, these steps represent the metaphoric bridge. So step 4 says, okay, well, if you're in the market, so if in, then where should I be? And if you literally just ask one additional question, not 21 additional questions or 300 additional questions or 10 hours of reading a day, but literally just asking one additional question, which is, if in, then where? If you add that second question, the way your money accelerates is noticeable. And let me just give you an example. If you just bought and held the S&P 500 between 2000 and the end of 2016, those 17 years, you'd have grown your money about 51% over any 7-year rolling period. But if you would have asked the first question, which is step 3, should I be in or out, that 51% goes to 175%. If you then say, okay, well, if in, then where, that follow-up question, which is step 4, that 7-year rolling average goes to 215%. Now, it's hard to kind of grok or grasp with those numbers is by asking those 2 questions, and I'm going to go in reverse here, your $10,000, your theoretic $10,000, I'm not taking into account taxes, okay, or commissions on trades, but your $10,000 becomes $90,000 over that 17 years. If you would have just asked the one question, your $10,000, okay, which, you know, maybe you start with 100,000, maybe you start with 1,000,000, but your 10,000 becomes 30,000 by just asking one question. And then if you asked no questions, your 10,000 with dividends reinvested becomes 21,000. So no question, just using step 1, yeah, and step 2, you get 10,000 to 21,000. Add step 3, your 10,000 becomes 30,000. Add step 4, your 10,000 becomes 90,000. Now, huge disclaimer, I don't know if you would have followed any of this, if you would have done partially an account, half of your account, 10% of your account. The point is not to say and focus in on 10 becomes 20 or 10 becomes 30 or 10 becomes 90. The focus is, if I just ask one question, or if I just ask 2 questions, what a difference my life can be by just asking 2 questions. Just powerfully simple questions and simply powerful questions. And then the 5th step is you gotta have the right partnership. And I think of Paul McCartney and John Lennon. It was the connection of them that created the Beatles. If you would have just had one of them and not the other, there would actually be no Beatles. And so what I notice a lot when I see people even doing things well, they do it in this kind of this splendid isolation. And what I've noticed is if you find that right partnership, it's one of the differences that makes the difference. So if you add those 5 steps together, that is the bridge that gets you to the other side of the river, which the other side of the river is the stability, is the security, is the safety, right? It's about aligning your money to the market. And to me, after I've been in this business for 2 decades, that's what people are looking for. They're looking for the alignment. They're looking for the stability. They're looking for the security. But they only have ever known that there's these 2 camps. The problem is those 2 camps, the long only big box camp and the pick of the month newsletter camp, they're on the wrong side of the river. And it's noticing that there's a bridge there. Hey guys, this is just another step in helping you protect your portfolio and your future. Until next time, this is RC Peck. Hey guys, if you value this, please like, share, and forward it because it makes a difference. Okay, thanks so much.